Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Spotify stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 57 billion market cap. They're trading at $2.88 a share and they have 199 million shares outstanding. Spotify is an audio streaming and media service provider. They are one of the largest music streaming service providers with over 615 million monthly active users, including 239 million paying subscribers. It offers more than 100 million songs and 6 million podcast titles. Their service is available in almost every country, although 2/3 of its revenue come from the US and Europe. They don't have any presence in mainland China, where the market is dominated by QQ Music. And their service is available on almost any device. Computer, phone, pretty much anything. Roku. It is the 47th most visited website in the world, with 1/4 of its traffic coming from the US. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year, which is good. Their most ever in 2023. Just the other day, they released their first quarter earnings. We'll go through their results a little later. Their margins are still pretty low. They converted only 5% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative every single year, probably due to lots of stock-based compensation. Revenue is the sales for the company, and that grows each year. It was 8.4 billion in 2020, up to 14 billion in 2023. Revenue per share is $71. Each share price is $2.88. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 46 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 199 million shares. And we get a calculated stock price of $197. They're trading at $2.88, so they're trading at a 46% premium. It's a sell according to the model. It is hard to value this company because they haven't grown into stability yet. You can see their free cash flow is a bit volatile, and there's a lot of future growth potential. But if you're an investor, you need to figure out what the potential is. Is it 2 billion of free cash flow, 3 billion, 5 billion? Right now, it seems like there's more downside than upside. But as you know, the market is not based on reality. It's based on what people think the future will be. There are 60 companies in the same industry as Spotify, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't need to spend much in CapEx because they don't make anything physical, like Meta makes VR headsets. Debt to equity ratio is worse than median average, but 0.7 isn't too bad. They do not pay a dividend. They do generate positive free cash flow, way behind Google and Meta, also far behind Dash and Baidu. They rank third in market cap, of course, extremely behind Meta and Google, two of the largest companies in the world. Their price multiples look pretty weak, so they do appear overvalued, but investors are willing to pay 80 times free cash flow for this stock. They generate 14 billion of revenue. Baidu is more, and Baidu is about 40% lower market cap. That's why Baidu has a 1.9 price of sales, and they're 4.0. But they're still growing. Their 5-year annual revenue growth rate is 19%. Look at DoorDash, 97%. If you put $10,000 into the stock when they started trading, you would have been close to $25,000 after 3 years. Then you would have been down to $5,000 a couple of years ago. But the stock has rebounded, and you'd be in the green currently. Your $10,000 would be $21,000, 110% return, which is not too shabby. Let's take a look at that first quarter update slides. So you can see monthly active users up 19% from last year. In the first quarter of 2023, 515 million, now 615 million. Also up from the prior quarter, it was 602 million. Premium subscribers, the people who pay money, 239 million, up 14% year over year. Only up 1% quarter over quarter. Their revenue from premium subscribers is up 20% year over year. It's 3.2 billion in this most recent quarter. Ad-supported, that's actually down from last quarter. It's 389 million. They don't really make much money from the 388 million ad-supported users. That's like a lost leader. It's good to have them around because eventually some of those people will convert over to premium subscribers. And it also boosts your overall monthly active user numbers. And that's a really popular metric for investors. Gross profit revenue minus cost of revenue is 1 billion. Gross margin 27.6%. That's up from prior periods. Operating income positive. It was negative in the past. So that's a big milestone. Operating cash flow 211 million, 4x from last year, down from last quarter. For MAUs, they missed guidance. The guidance was 618 million. They came in at 615 million. They were in line with premium, exactly at guidance, 239 million. They hit their revenue target for Q1. They beat gross margin by a good amount, by over 1%, but they missed on operating income. They came in at 168 million euros. The guidance was 180 million. But the night they released earnings, the stock went up a lot. Here's monthly active users the last 5 quarters, 515 million in Q1. You can see it grows each quarter to 615 million. Premium also grows each quarter, and also ad-supported users grows each quarter. Their highest premium revenue ever, but last quarter ad-supported revenue was a lot higher. So last quarter total revenue was higher than this quarter. But last quarter was Q4. Q4 tends to be a better quarter for most companies due to the holidays. But their expenses are going down, so their margins are going up. Higher gross profit, higher margins. Operating expenses 836 million. That's lower than the prior 4 quarters with higher revenue, so that's really impressive. Highest operating income ever. I think only their second time with positive operating income, the first time Q3 2023. But they usually have positive free cash flow. Last quarter was about double this quarter. You can see premium revenue has grown a lot. In Q2 2021, 7.5 million euros. And the average user was only spending a little over 4 euros. Now the average user is spending a little under 6 euros. That's why they're making more money. They're adding users and each user is spending more money. And you can see ad-supported revenue also increases each quarter, but it's still a lot lower than the premium revenue. You should really focus on margins. That's a really important number to look at. And they're killing it. Look at their gross margin. So much higher than the past. And for both premium gross margin and ad-supported gross margin, they're crushing it, especially premium. Operating expenses peaked in the second quarter of 2023. They've been coming down. They're lowering their expenses through efficiency initiatives, a decrease in personnel and related costs, and lower marketing spend. And it looks like a decrease in stock-based compensation is a big reason for the lower expenses. They refer to stock-based compensation as social charge movements. They usually have positive free cash flow, but you can see in the most recent quarter, this is for the trailing 12 months, it was nearly 800 million. But for the first quarter of 2024, free cash flow of 2 billion euros. A euro is pretty close to a US dollar. Currently, 1 euro equals 1.07 US dollars. You can see that's their best quarter ever. In Q1 2020, 35% of their users were in Europe. That has declined to 28%. North America was 26%, that's declined to 18%. Latin America has been flat at 22%, but the rest of the world has grown a lot from 17% of their users to 32%, so they have a really wide reach now. I think about 90% of the countries in the world have access to their platform. For premium subscribers, 38% in Europe, that's been pretty flat. 27% in North America, that's down a little bit. 22% in Latin America, that's up a little bit. And rest of the world, 13%, that's also up a little bit. The outlook for next quarter, monthly active users 631 million, premium 245 million, revenue 3.8 billion euros, gross margin 28.1%, operating income 250 million. If they can hit the 250 million, I think it's smooth sailing after that. But I think these targets are achievable. Monthly active users each quarter, the last 12 quarters, you can see it grows every single quarter. It was only about 360 million in Q2 2021. It's up about 80% since then. This dark blue section is premium subscribers. The green is ad-supported users. You can see the green goes up a lot more. which is fine because hopefully more of the green convert over to premium. And here's their total revenue. The blue part are premium revenue. The green part is ad supported. Both are growing. Gross profit, it's mostly from premium subscribers. As I said earlier, ad supported is almost like a lost leader. They don't really make much money there. The small amount of revenue just barely covers the expenses. Margins are south of 10%, while premium is slightly below 30%. Free cash flow the last 10 quarters, its highest ever in this most recent quarter, 800 million euros. That's about 850 million US dollars. First quarter 2023 revenue, 3 billion. First quarter 2024, 3.6 billion. Gross profit, 1 billion. Here's their expenses. R&D, 389 million. Marketing, 324 million. G&A, 120 million. Total expenses, 836 million. Down a lot from last quarter. Down a little from last year. That's why they have high operating income, 168 million. It was negative before that. They received 59 million of interest on their investments. They paid 53 million of interest on their debt. So that gives them $6 million of interest income. Net income, 200 million. It was negative before that. So they have an EPS of $1, earnings per share. Earnings per share is net income over shares outstanding. Their shares outstanding equal their net income. 198 million shares outstanding. That's why their EPS is about $1. That is higher than the past. Last quarter, 196 million. Last year, 194 million. But as they become more and more profitable, they'll start to buy back stock. Right now, they seem to be adding stock. Let's look at their balance sheet. Current assets, 5.6 billion. Current liabilities, 4 billion. So they have a current ratio above 1. They have lots of cash, 3.5 billion. Investments of 1.2 billion. Looks like they do a bunch of acquisitions. Goodwill of 1.2 billion. Long-term investments of 1.5 billion. Looks like a pretty solid balance sheet. Total assets of 9 billion, higher than last year of 8.3 billion. Equity is assets minus liabilities, 3.3 billion of equity. They raised 5.4 billion from selling their business, selling stock. They lost 4 billion from running their business because they usually have a negative net income. Let's look at their statement of cash flows. Their operating cash flow was higher last quarter, 400 million. This quarter, it's 200 million. So even though they had negative net income in the past, they still had positive operating cash flow. Not much going on in the investing section. In their financing section, there was some stock options, 242 million. Here's their free cash flow since September 30th, 2020. It was 103 million. And you can see it's positive every quarter except the fourth quarter of 2022. They had negative free cash flow. But outside of that, it looks like they're generating positive cash flow. They just have so much non-cash expenses, probably stock-based compensation. That's why they have negative net income. But this is not a lot of cash flow. A couple hundred million is nothing. When you have companies like Meta with 40 billion in a quarter. I know it's a different animal, but if you want to hit the 100 billion market cap, a couple hundred million is not going to do it. Let's look at the stock on Simply Wall Street. Its last price, 281, 60 billion market cap, down 4% in the past week, up 111% in the past year. Let's see what they say about the company. Spotify provides audio streaming subscription services worldwide. It operates through two segments, premium and ad-supported. Their premium segment offers unlimited online and offline streaming access to its catalog of music and podcasts without commercial breaks. This segment sells directly to the end user. The ad-supported segment provides on-demand online access to its catalog of music and unlimited online access to the catalog of podcasts to its users on their computers, tablets, and mobile devices. They also offer sales, distribution, and marketing, contract R&D, and customer and other support services. They were incorporated in 2006, based in Luxembourg City, Luxembourg. Here's the stock price since they started trading in 2018. They pretty much traded sideways over the next 2 years, up and down a little bit, but didn't go anywhere. So in May 2020, you're still flat if you bought them at IPO. Then 9 months later, in February 2021, they hit their all-time high at 350. That was a great exit, because if you bought in then, you were only downhill. From February 2021 to December 2022, the stock went down significantly. So over that 2-year period, it went from 350 to the low 70s. But it's done really well since then. From December 2022 to current, It's gone up about 4x. Simply Wall Street's valuation is $376. They say the stock is 25% undervalued. 34 analysts priced this stock at $319. Their revenue forecast for 2024 is 15.7 billion euros, 2025 17.8 billion, 2026 20 billion. And their free cash flow forecast looks pretty strong, 1.5 billion in 2024, 2 billion in 2025, 2.2 billion in 2026. Their revenue back in 2015 was 2 billion euros. It's a straight line growth year over year. It looks like they never have down years, they just keep going up. Currently at 14 billion. Here's their debt since 2016. They were debt-free in 2018, 2019, and 2020. Then they added 1.2 billion of debt in 2021. It's been pretty steady since that point, currently a little under 1.3 billion. But you can see their equity is usually higher than their debt. Currently their equity is 3.3 billion, so they have a good debt to equity ratio. And this green line is their cash. Their cash is a lot higher than their debt, a little higher than their equity. The CEO's total compensation is 1.3 million. Tenure as CEO is 18 years. 60% of the company is owned by institutions, 18% by insiders, 14% by the general public, and 8% by public companies. Their biggest shareholder is a UK company, Baillie Gifford, 12%. One of the co-founders owns 11%. The Chinese game giant Tencent, 8.3%. The other co-founder and current CEO owns 7%. Lots of big names own the company: Morgan Stanley, Wellington, JP Morgan. Their employee count was 2,100 in 2016. It peaked at 9,100. It's come down to 7,700. And the ticker trades on the Swiss Exchange, London Stock Exchange, New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, Euro TLX, Wiener Börse, Sao Paulo Bolsa, and Buenos Aires. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.